Hello, I'm Vanessa Stoikov. Welcome to Wicked Problems, Visionary Investors, where we tackle the biggest problems we're facing with leading experts in the investment community. In the first part of this program, we started tackling the issue of sustainable investing and specifically the role of advice in the process.
Today's Wicked Problem: how do we understand the best way to invest sustainably as more investors are considering ESG? Why is sustainability so important for investors now? And how can advisors approach the critical factor of sustainability when it comes to investing?
Welcome back to my guests. Stephanie, Damien, welcome back.
Thanks, Vanessa.
Okay, financial advisors and how they're communicating with clients. Damien, firstly, for you, you have a big advice network. You're one of the biggest, actually, of all super funds. How do you think they go about, well, how are they going about communicating?
It is part of what we do. So we talked last week around the way we're engaging and integrating ESG into how we invest. And our advisors are very focused on ensuring that our members, our clients, who are quite focused on the issues we talked about with sustainable investing, are really understanding what's happening and thinking about how their investments are going to have an impact in the future. So it is part of their conversation. Some clients will be more focused than others, but on average it seems to be quite a key issue for our advisors and their clients.
Okay. And Stephanie, how are advisors engaging with like Schroders? I mean, are you giving advisors training and materials? How do you go about engaging with that advisor community so they are understanding this wicked problem and where they fit in?
Yeah, it's yes, we have a lot of those things. We have webinars, we have continual thought pieces on educational pieces. As we discussed last week, there's a lot going on in the space. So I think an area where most people are comfortable starting on is in the equities asset class, but we're trying to also help advisors understand how to bring it together at a total portfolio level, how to address some of the individual asset class challenges in, say, fixed income or private asset space. So how can you bring a total portfolio of sustainability together is probably the next part of the conversation, given that all the things we've already touched on, and that there's a more grey area and that the economy is transitioning. In fixed income, for instance, you hold sovereign bonds. How do you engage with the government? I mean, there's different nuances for each asset class. And so I feel like that's probably the next stage of how we do sustainability in other asset classes will be the next sort of iteration of that conversation.
And now, Kylie, you're in with our advisors in Second Studio. Talk to me about what they're saying around sustainability.
Thanks, Vanessa. I'm here with Vaughan Hain, who is from Eth Invest. I think where you're from says a lot about what you do and part of the reason that you're here tonight. But tell us a bit about, your business and the ethos.
So I've been with Eth Invest, has been around 30 years. They're specialised in ethical investment, so probably about 15 years early for the general market. But yeah, very much catered to the sort of dark green end of the spectrum. So it's not all that we do, but that is what a lot of our clients come to us for.
I'll hold this. So I guess clients come specifically to you for ESG, but we were talking a bit before, and it's not just a simple kind of ES or G. There's a lot more to it for your clients. Yeah.
So personally, my view is that ESG is really more of just a financial screen. It is about just protecting returns. A lot of our clients are really looking for what we call ethical investments, where they really want to support the companies. They're happy with what they do, happy to be involved with them. It's not just an investment that makes some money. Doing that, as basically the performance does differ from the benchmark, but over the long term, I think it does provide good returns or even better returns, because you are avoiding a lot of those companies with risk and sort of being on that front edge almost of the ESG.
The panel talked earlier about some of the challenges for advisors and for anyone really in this space in getting quality information about investments. How do you go about sort of vetting where you put your clients' money?
So we've got a sister company, Australian Impact Investments, that does a lot of the research with us. But we really do quite deep dives into any fund that we'd ever look at. So just looking not just at the policy, but also the holdings. If the holdings look great and the policy doesn't really exclude investments that wouldn't be attractive to our clients, they won't get a good rating. But our rating process is a lot about informing the clients around what is in the particular fund. Some clients have different views, some are quite against mineral extraction, some are quite keen on lithium, and so you've got to really discuss what that client is looking for and build them portfolios to match.
Okay. I'm going to ask you a question, and that is, do you have a question for the panel?
I was just wondering how they sort of reconcile the differences between sort of an engagement strategy, which totally support that, but also at what point do you think divestment is appropriate, and how do you make that decision?
Vanessa, that's a good one.
Thanks, Kylie. Yeah, that's a good one, and I think I'll get both Damien and Steph to have an answer. You first, Damien. How do you go about that?
Yeah, so we actually have divested from some assets across our fund. So we've divested from tobacco.
Okay.
We've divested more recently from thermal coal producers and controversial weapons as well. So we have to form a view that the future revenues and profitability of those industries are challenged, and so those companies can't transition to an outcome that is appropriate from a financial risk perspective. So we've made a decision for those three industries that we don't invest.
Okay.
We have a preference for engagement, so we make that decision a long way down the path of trying to engage with those companies. And so, thermal coal producers, we've been engaging with those companies for a long time and formed a view that that industry was going to be difficult for them to transition to a lower carbon future. So we made that decision, but it's one that has to be based on financial outcomes and the risk of future earnings.
All right, well, which makes sense, right? That's what you look at every investment as.
Yeah.
So it's the same thing. So you would divest if you see no real financial future for that firm.
Yeah, and look, I mean, tobacco is a fantastic example of that, where it's going to be very hard for a tobacco producer to change their business model to remove a product that obviously impacts people's health. So we made that decision quite some time ago.
I don't know where vapors came from, vapes, but that's a whole nother thing.
Yeah.
Steph, talk to me, how would you look at it from Schroders, from a divestment perspective?
So similar to Aware Super, Schroders has got all of our funds in Australia have minimum exclusions, which similarly are tobacco, manufacturers of cluster munitions and nuclear weapons, and also more armaments. That's another one I can't say.
Yeah.
But and then more
sort of like Tony Stark stuff. If you watch Iron Man, all the stuff that Stark Industries do is what you're excluding, right?
Correct.
Gotcha. Okay.
And then more recently, we have introduced a revenue of more than 20% from thermal coal mining will be excluded, and that's on all of our funds offered to Australian investors. Our sustainable funds generally have more exclusions on top of that, but that's generally defined by their own sustainable investment framework for that strategy.
Okay.
So there's another spin on this question in terms of engagement, and maybe when do you say engagement isn't working and when do you start to divest from a single corporate name?
Okay.
So in Schroders' experience, we've been doing corporate engagements for over 20 years. In general, we've found, looking back at that sort of history, that it takes generally at least 2 years before a company starts to make progress on any of our engagements, and more frequently we look at it in a 3-year time frame.
Okay.
And we try and start to measure progress. Again, there's that word. But at some point we have to say, is this engagement with this company working? And if not, there's escalation approaches that you can take. So more recently, Schroders pre-declared their voting intentions for Shell, ExxonMobil, and a few other oil and gas companies, because we felt like they weren't making enough progress in enough time on climate transition factors.
So you got rid of them?
No, we pre-declared, and we told the company that we were going to vote against a shareholder resolution that was raised saying that they weren't making enough progress in the right time frame. So that's an escalation before you then divest and say that they're never going to get there. We do see companies are making progress, and so we're trying to continue that conversation and encourage that progress. So for us, divestment is almost like the last stand.
The last straw.
Yeah.
Okay, I'm imagining Dr. Evil pressing the sharks, open the thing, they fall down, button, of you're out.
Yeah,
So,
exactly.
Not quite that dramatic, but
yeah, okay. It's just where my mind goes. Okay, now Kylie, do you have another advisor question?
Thanks, Vanessa. I'm here with Harrison White from ARC Global. Harrison, we've been talking and watching everything that's been going on. I want to pick up on something that Vanessa said in part one of this episode, which was about a room that she went into of 80 or so advisors, and she asked them, how many of their clients are actually interested in ESG and, who put it at the top of their list of requirements. And she was quite surprised that the number was quite low. As an advisor, does that surprise you, or does that sort of match up with what you're seeing?
Yeah, it's probably about right, I think, with what we see. I mean, I think a part of it is a function of the fact that, 85% of our clients are probably 55 and over, and so they generally have not come from an age and grown up in an age where sustainability is a massive thing. So that's probably no surprise to us. But we're starting to see it more and more as it's becoming more at the forefront of people's minds. But yeah, that sounds about right from what I've seen.
Yeah. So are you starting to see in your sort of any of the younger people that you come through, is the conversation quite different?
The conversation is definitely different. I think if we were to look at our clients that are probably 40 and under, it'll probably be much more a 50-50 split in that space, and that's just because it's just more an awareness and a driver of those. They haven't had portfolios where Rio Tinto, BHP and companies like that have been the main driver of their returns growing up. So it's just a very different perspective that they're coming from.
What are the challenges for you in getting quality information that you can share with your clients that is, easy to understand? Because we also talked about, the mountains and mountains of regulation that sort of sit above you and how much information you need to provide. How simple is it to get the information you need and to communicate that in a simple way with clients?
Yeah, it's very, very hard to do. I mean, ESG is subjective in so many ways. Fund managers might think about it one way, advisors think about it another way, and then clients think about it another way. So it's very, very difficult to try and communicate, between all those three parties. I think what we'd like to see is more data on, how sustainability, can impact, returns both positively and negatively, so that we can have those communications with clients. Because I think what we see is a lot of sustainability factors, and, you look at, risks in companies, if they're not adapting to the future, then they're probably not going to be, a good driver of returns for your portfolio going forward. So I think a lot of the time portfolio managers and the really good ones are doing it anyway, but they're not necessarily communicating that as an ESG factor. So seeing more of that, some data and client ready research and reports on that would definitely be really helpful in climate conversations.
And what about you mentioned climate, client conversations, but do you get questions, and is it difficult to kind of delineate between when people, are specifically interested in the E or the S or the G, because not everyone might be interested in all three, on an equal basis?
Yeah, it's again very difficult because you can have an ESG fund, but where are they focused on the E, the S, or the G? So it is very difficult, and I think we just having more clarity about how that fund is ESG, is that they're looking to make an environmental impact by reducing the carbon footprint of their portfolio, or is it a fund that's looking to make social change by giving money back to communities or investing in funds that make a genuine community impact? So more clarity about that, and it's we can just have S funds and G funds. It doesn't necessarily need to be all of them, and that would again be more helpful for client conversations.
Okay, so off the back of that, do you have a comment for the panel?
Yeah, I think you touched on regulation, and that's a big one. And often in the financial world, regulations are the thing that gets us moving quickly. So what I'd like to ask the panel is, what regulation change would you like to see made as a way to kind of help drive this shift towards a greater ESG kind of focus in the investment advisory and companies out there?
More regulations, Vanessa.
Thanks, Kylie. Okay, again, I'm going to ask both our panel. Steph, I'll start with you this time.
Yeah, sure. There's a lot of regulation that we've seen offshore in other markets, and we've seen the impact of that. And it's brought, I won't lie, it seems to have brought a lot of work, a lot of reporting requirements, a lot of conversations that advisors, fund managers haven't had to deal with before. So it's sometimes like turning a large ship around. So when the question is what regulation would we like to see, I think it's more about when it comes, because we can see there's something called the ISSB, which is being finalised at the moment, and that's going to be standardised sustainability reporting framework for the globe.
Sounds fun.
Yeah. But with that, we are expecting at this stage that companies will be forced to do what we call TCFD, another acronym, and I'm sorry about that, but that's a climate transition plan, or a report that acknowledges how they're going, where their emissions profiles are today, and how they're going to meet targets for net zero.
And what was that called again?
A TCFD report.
Okay, I thought it was like a
task force for
Financials disclosure.
Carbon
financials disclosure.
Not taking care of business, okay? Good to know, okay?
Yeah.
So we want to know when this regulation will come more than anything, because it looks like it will come because it's happening elsewhere.
It will. And I think once we get some sort of a standardised framework, a lot of those sort of grey area challenges we've touched on today might just be solved for in time. Yeah.
Okay. And Damien, regulation now in your wand of things to think about?
Well, I think the one that Stephanie's mentioned is absolutely critical. So that TCFD mandatory requirements for companies is just would be such a help for us to understand what their plans are and have a common language to that transition as well. So we've been advocating with that, or for that, with government, and we believe that there's a positive will to do that, and we think it'll make a great change. So I'd say that's really critical. I think just the standards of reporting to help people to understand what's happening more broadly. So as a fund, we lifted up our disclosure and our reporting around what we're doing from a stewardship perspective, so how we're voting, what we're expecting companies to do, what our portfolio looks like, how we're investing, and we'd like to see a broader standard so we can get away from the greenwashing issue that we touched on previously, where you've got a much better understanding of what's actually happening, and there's a consistency of message and language that just helps investors really know what's happening.
Okay. Well, I think for advisors, they hear the word regulation and they want to run because we've had so much with the Royal Commission and everything that came out of that. But what I'm hearing here from both of you is that the regulation's necessary, there's more coming, but it may clear up the grey and make it a bit easier to navigate. Yeah?
That's the aspiration.
Absolutely. I think the TCFD would do that.
And how far away is this TCFD?
It's been discussed for a while.
They're finalising it at the moment, and even then Schroders' view is implementation will still take a few years to have all companies reporting to this framework. I mean, Schroders has done it.
Plan?
Probably in Australia.
We'd hope a bit sooner.
We'd hope a bit sooner.
Yeah, we'd hope a bit sooner.
Yeah.
And some companies are already using it.
That's
already
right.
doing it, but it's not mandatory yet.
But things are changing and it feels positive. So I think from a wicked problem perspective, certainly we haven't solved it, but we're a lot closer than we were even 2 years ago. So this is good news.
Yeah.
One of the points that was raised before, which is really interesting to me, is just the different focus across different generations.
Yes.
I was going to tell a story about my son who's 20, and I was talking to him the other day about what his future is, and he's got a nice young girlfriend, and they're sort of talking about the future, and I said, so what's your thoughts on the next 10, 20 years? And his response was, we're not talking about that because you're stuffing up the world anyway. So, we're not worried about the next 30 years, we probably won't be here. So, although that's a pretty negative view of the world, isn't it?
Generation X can't take the rap. We've just been in the middle.
We're stuck in the middle.
Okay, well, I also have a 19-year-old son who's doing van life around the country with his girlfriend, and they're really into sustainability now, and she's a vegan. I have not gone that far, but I do buy vegan plant-based meals a lot more than I ever have.
Yes.
So I feel like having someone in my family now has helped us. So perhaps advisors can kind of be like family and help people do those little things along the way that help them get it.
The other thing I'd say too, just in the private markets, there is a huge amount of innovation around, whether it's low carbon technologies, whether it's food innovation. There's just huge amounts happening. I mean, there really is around the world, particularly. We invest in all sorts of different things that would just be amazing.
Do you feel hopeful? I mean, you've got a cool job when things are, I mean, not always, let's face it, but when things are going bad, probably not so much. But do you feel excited when you see all the ideas?
There's real energy and innovation in the world. So I'm positive that we'll get there. But as I said, we need to see progress soon.
Okay.
So that's the progress over perfection.
Okay.
comment.
And Steph, final words. How do you? I mean, you're a different generation again. Even I get blamed for half the stuff for my kids. I'm like, I'm just nearly 50, for God's sake. I didn't do all that. But how do you feel as a fund manager? And I mean, obviously Schroders is a big name in the game. How are you feeling?
I feel positive. I feel like sometimes it's easier to read the media and watch the floods and feel quite despondent.
I keep telling Mum, stop watching the news. Like you cannot help.
Yeah.
But
I think what it helps working in this space, you see how much is going on, and so much of it isn't being captured by backward looking or where we are today. And it goes back to the innovation. I mean, things like circular economy principles are being brought into investment portfolios. There's some really cutting edge stuff. Things like biodiversity and its role in carbon sequestration. You know, like if we do get this right, I think it will work.
What's sequestration?
It's like where you keep carbon in the ground, like trees suck carbon from the atmosphere. And so every time you chop trees down, you're losing a source of carbon sequestration. So I think, I can't remember which of the many environmental groups said it, but I think roughly 40% of carbon emissions can be linked to natural resources and carbon sequestration activities. So there's also things like climate tipping points. So if one of the climate tipping points goes, then you know the Amazon rainforest is at risk.
I was just thinking of that, right?
Exactly.
And then you think what's happening with the third world countries that want a seat at the table, and that's perfectly normal. Like, why wouldn't you? But that means they're consuming a lot. A lot of people talk about China too and emissions and those things. Damien, I mean, that's geopolitical risk, I guess you're going to tell me, but what's your view on, can we have an impact on those kind of countries?
I mean, I think that they're also focused on how they're transitioning. So if you look at a lot of these, I was in Indonesia the other day with the government group, and you know that economy is focused on how they're going to create a greener world, how they're creating new investment opportunities to transition to a lower carbon future for them. So I think clearly they're at a different point in their growth path. You know, they're moving towards middle class. You know, they're increasing the average wealth of their economy, and that's a process that tends to see high usage of or higher fossil fuel emissions. So they're going through that process. But I think the world is clearly very focused on the problem. So I think developing countries are very focused as well, although they're at a different point in their journey.
Thanks everyone, and that's all for this episode of Wicked Problems, Visionary Investors. Our next wicked problem is completely vexing. Here's a sneak peek. Inflation, that's where everyone's really focused. Talk to me about your view on that.
It is important to be thinking about each investment you make and how is that investment positioned to weather the storm of inflation or rising interest rates.
It's a period of transition. A period of transition is sometimes painful, but it does mean I think there's going to be other different investment opportunities from maybe what there was over the last 10 years.
I'm Vanessa Stoikov. Thanks for watching.